Welcome to the weekly meeting, March 2nd, 2024. Okay, today I kind of wanted to kind of hit on this on what I look for, when I take my trade. Like confirmation, what to expect out of the price action, and then kind of my thought process as the trade is taking place. There are many styles to trade. There are many ways to find success. I've found success this way. Kim teaches a little bit different way, and Newhoff does his a little bit different, but they all work, right? My grade A setup comes out of the ICT mentorship model. I just want to go over something real fast. Okay. To oversimplify this, all right, I need to get rid of this. So to oversimplify what I do and what I look for, I'm just going to draw it out. For me, I'm looking for the market to be on an uptrend, the market to come back and violate this structure. Then I'm looking for the market to come back and trade into this imbalance so I can take a short. Right here. I will protect the top of this candle or swing high. There's no wrong way to do it. Whatever you decide to do, you do it for whatever reason you do it. I would target the discount, the 50% of this entire range that created this high. So this range came from somewhere down here. So this range came from somewhere down here. I would fib, I would target the 50% of that range, and I would look for liquidity in that range. Maybe that liquidity is an order block, maybe it's an imbalance, maybe it is some equal lows on a lower time frame that I expect price to come and take out. Does everybody understand that?
Yes.
On the flip side, if the market is going down, I would look for the price to come down, being low, a lower low. Then I want to see price break this high, right? Once price breaks that high, I want price to trade back into an imbalance that broke this high to go higher, right? Now, and I would target the same thing, 50% of the range coming down or an old high, somewhere along this range. There are many ways that I can get my target, right? I get my target from the higher time frame, maybe. I'll get my target from an internal level of structure, but it's always going to be based off of a premise that the market is going higher based on the higher time frame, or the market is going lower based on a higher time frame. So that's how I know when to sit and wait for this move to happen, because the higher time frame might have already told me the market is going lower. Now I just need to wait for this particular move to happen for me to be able to take advantage of the trade. Does that make sense? Okay. I'm going to go back. At the end of the year, we had a bearish order block, right? I know this is the 2-month chart. I don't care what time frame it's on, whether it's the 2-month, whether it's a 1-month. In this particular case, this is the 2-month chart, right? So, they always tell you to go two time frames down to get your entry. If your setup is on a 2-month, you need to go 2 time frames down to get your entry. So maybe you get your entry on the 2-week in this case, right? No higher than the 2-week. But because I understand the market the way I understand it, I went all the way to the 4-hour to get my entry for this 2-month setup, right? It's because I know that after this candle happens, what I personally expect is a pullback, right? When does that pullback, when should that pullback happen? Well, there's a great chance that the pullback will happen immediately, right? Every now and then it doesn't happen immediately. But I'm expecting this to happen immediately. If it doesn't happen, then I don't have a trade. No harm, no foul. But I still have to go to the scene of the crime, right, in order to find what I'm looking for. I still have to go and stalk the trade setup to find what I'm looking for. So I can go all the way down to the 4-hour. And maybe some of you will prefer to go to the daily. All of it works. We already talked about what we're looking for. Price is coming down. It's pulling back, right? What you need to see is for once price finishes going down, you need to see that break up, right? That breaks that high. And then you want price to come back in and let you in. And then price to start pushing up. Okay? Whatever time frame you need to see it on, there's not a right or wrong answer. But me, because I expect to see this immediately, I want to go to the 4-hour. And I'm looking at price pushing down, right? Pulling up, pushing down. So when this pushes up, I need price to break this high, right? And then pull back to let me in the trade. Now I get my break. And it's pulling back. I mean, it only pulled back to this moving average line. I got my break of this high, and this pullback is when most people would have got in the trade, right? Now, in this group, we kind of talk about this moving average. Now, I know this moving average is not the holy grail, but if you're a swing trader, if you're a good swing trader, you're probably going to use these moving averages to tell you when to add or when to enter, when it's good. So once you got this break above that high, this pullback would have been your entry. Now I got my entry right here on the first break, right? Right after the open. We had to wait an hour. I got my entry. I think a lot of people got their entry the same spot because everybody kind of believed the same way. But the safest way was once you got this break, now you get a retest. Now we're going the opposite direction, right? And if you notice, this candle left a lot of imbalance. So we had to trade back into that imbalance to roll out. And if you drop down time frames to the 1 hour maybe, then you have a lot more confluence. You have your a little imbalance in here. If you drop down to the 15-minute, you might have caught that. And if you put your stop loss here, it wouldn't have stopped you out, or maybe your broker would have taken you out. But if you gave it a little bit of space, you would have been in the trade from the 1 hour and you could have pressed up. All right, that's what it looks like on the chart. That's what it looks like kind of with looking at the candles. You know, some traders would have got in when they saw this wick because they understood that it was a run of the liquidity from the bottom of the market. It pushed up. We broke these highs. We came back. Maybe you would have gotten the trade on this pullback to this area that wicked out. ICT will tell you that this is your order block right here, starting at that red candle. So you could have waited for a trade to come to that order block, and you could have gotten a trade to go higher. Or if you would have been waiting for this order block and this wouldn't tap you in, as long as you protected that wick, you would have still been in the trade. There's many ways that you could have found to enter this trade if you wanted to do it on a lower time frame than the 4 hour. The 1 hour gave you your break right here. There's your break on the 1 hour. All right, any questions? All right. This setup is you'll hear ICT talking about this setup. This is his 1 hour chart. He's going to show you a trade, basically the same thing. The market comes up, establishes a high, we run that high, we come back, we break this low. Now the trade trades right back up into the imbalance, and he takes the short.
We're anticipating a move up. What's it going to be trading up into? This imbalance in here. Okay, so once it does that, it kind of like forms the daily high, and then the rest of the day, you're going to be looking for distribution throughout the day, looking for lower prices. So inside that little shaded area, we're going to use that going forward. So let's drop down to a lower time frame. 15-minute time frame. Here is that imbalance. It doesn't look.
So this, he used a different range, but it's the same thing. You'll see the same information. And he went from the 1 hour to the 15-minute.
That clean on the 15-minute time frame, but the hourly is what we're framing it on. Okay, so the market trades up into that. Here is the midnight New York local time candle on the 15-minute time frame chart. Opening price is here, extended out throughout the day. That is your midnight New York candle opening price. Preferably, if we're selling short, we want to see price trade above this opening price. This is where smart money is accumulating short positions. See that? So the algorithm goes higher, once more higher, once more higher, and then again right here, and then begins its descent into the daily range low. Now, what's occurring here? This is not buying and selling pressure. The algorithm is offering constantly price above this opening price. Now, every single time it rallies up, just because it does that doesn't necessarily mean that's a time for you to get in. But when you couple that with time of day and price, it becomes a lot better. Notice we have an imbalance in here. So the fair value gap there and price runs up during the New York open kill zone. Okay, so I dubbed this specific time of day between 7 o'clock in the morning New York time to 10 o'clock in the morning. This is specific to Forex. Okay, these times are specific to FX pairs. If you're going to trade an index, don't worry about that. You can work with the 8:30 to 11 o'clock New York local time. But for Forex, the algorithm is going to operate on these specific elements of time. So if we're looking at this imbalance here, the market runs up and it overshoots the imbalance a little bit, but what's it really go to? The last up close candle, which is a bearish order block. How do we know it's a bearish order block? Because we have the imbalance here and it's trading back up into after a nice move lower. So this displacement, fair value gap, last up close candle, touches it, there's your bearish order block. Dropping down into a 5-minute chart, everything being as it was on the 15, that's that order block here, just being shown on a 5-minute chart. I'm adding now the annotation of the New York open kill zone. 7 o'clock in the morning begins here at the end of that line segment, and 10 o'clock is here. So everything underneath this end of the trend line here and below this part of it, this all is during the New York open kill zone. So you're hunting your setup for Forex pairs within that little block of time. So during this time, you're hunting your setup. What price are you looking for? Preferably at or just above the opening price at midnight. Now, if you are a New York session trader, you want to refer to the opening price at midnight, but then you want to recalibrate at 8:30. And we'll look at that in a moment. But for now, just notice, looking at this particular day on the economic calendar, we had a high impact news driver at 10 o'clock in the morning. It was the ISM Services PMI number. Now, before you want to start sending me emails or start sending me essay questions in the comment section of this video about what does the ISM PMI number do, I don't care what these numbers are really discussing. I don't care. I don't care about the raw data. I don't care what the expectation is. I don't care. Okay. What I'm expecting is the volatility in the marketplace at or around these specific times, because the algorithm is going to use that injection of volatility to facilitate trades. Now, is it trying to give you good trades? No. It's trying to move and rebook and reprice to levels to allow those in the know to participate. It's a rigged game. You're not supposed to be in it. Not consistently profitable, let's say it that way. But for those that are in the know, they're looking for these types of signatures and price action. So they know what they're looking for in terms of when they're going to operate. So as a technician, they're looking for a specific element of time, which is encapsulated with this segment right here, 7 o'clock to 10 o'clock. So that little bracket of time right there on a 5-minute chart, you're hunting your setup. What is the thresholds that make it high probability? Well, if you're going short or looking to go short, and you want to be above the midnight opening price. That's here, extended out in time. But now, once we hit this order block here, that was during the early stages of the New York Open, right around the 7 o'clock hour. The market drops and then retraces back into that news driver here at 10. So what's happening here is, look closely with this swing low. It went below this low here, and then it rallied back up once more above the opening price at midnight. Does it take out this high? No. Why doesn't it take out this high? Because it has an imbalance here. That imbalance tells you this is an intermediate term high. If we're bearish, it shouldn't take this high out. Now, again, I mentioned this in a recent video. I think, if I'm not mistaken, it was episode 12. I'm going by memory, so please don't roast me in the comment section if that's the wrong one, but it's basically what I'm talking about: intermediate term and short term and long term highs and lows, or swing highs and lows. An imbalance or fair value gap associated with a swing high or swing low. In this case, this is an imminent term high, not because it just simply has a imbalance, but because the narrative is we're expecting lower prices, and it went above the opening price at midnight. And the imbalance there, when it retraces back up into this fake run ahead of the news driver at 10 o'clock, the news, if you will, this movement here is only running right back up into the bearish order block. Last up close candle, the body. I don't like to use these long tails and wicks. I'll refer to them, but I like to prefer to annotate if I'm going to show it in my examples, or look to price returning back to the body of the candle. Right there. So this return into that order block sets the stage for another move lower. We get a swing high, lower high to the right of this candle, and a lower high to the left of it here. So we have three candles making a swing high. So we start looking for displacement and movement lower. But looking closer, after we had that shift in market structure here on a 5-minute chart, it retraces back up, fair value gap, bearish order block, and news. This is the wild card. Okay, when you have high impact news drivers, this is going to many times scare you out of the trade or stop you out. In other words, if you went short back here and you started trailing your stop loss, this is what that's designed to do, take you out. So if you're short back here or here or here, how are you protecting the trade? You're putting a buy stop above recent swing highs. So they're jamming it up against that, back above the opening price, because your buy stop is going to flood the market with buyers willing to pay at a higher price than it was here before it runs higher. And you're going to buy, or those individuals that have those stops, they're going to buy the counterparty side of the smart money that wants to sell short. Because every buyer has to have a seller, every seller has to have a buyer. So that's what's occurring here. But inside this shaded area, I'm going to show you how this model is applicable here in FX. So here's the 4-minute chart. We were just looking at 5. So we start stripping down this price leg here, and we're looking for any fair value gap. Do you see it? Pause the video, look for it. All right, I'm about to show you. This candle's low, this candle's high, there's your fair value gap. Isn't it interesting how this goes right up in there, closes that in, then and only then the market starts to aggressively run below the short-term low here, and then reaching into our objective down here at that 109 big figure. Now, it doesn't quite get to 1.09 even, but it does get to our Fibonacci extension for the standard deviation. It does get down to the old relative equal lows on the daily chart, which is what that blue line is. Look at the bodies respecting that level. Not much movement below it. Now, for all of you raw dogs out there, okay, this is too much, Michael. You're overcomplicating it. You're confusing me, Michael. You're talking about the midnight candle for the opening price, and now you're talking about the 8:30. Which one do I use? Why do I use it? This, that, other thing. All right. If you're only trading FX, you're going to be using the 8:30 in the morning for New York session trades. But refer to the New York open at midnight as well. If the opening price is lower at the 8:30 than that of the opening price at midnight, use the lower one. Reason why is you want to set the minimum threshold for a Judas swing or a market protraction to the upside when you're bearish. And obviously, everything that I just said would be reversed. If you're bullish, you'd be looking for a move below the opening at 8:30 to go long after it moves below it. But we're focusing primarily on the shorting opportunity here in hindsight, so that way you can get a better feel for how to use this model with FX. So there's a subtle little group of nuances that you have to be aware of when you're looking at FX, but it's not terribly, harsh. It's pretty easy to work with. So we have the market trading above the opening price here. Market protraction due to swing. It rallies up and then breaks down in here. Now, this run here above the opening price, does it have a fair value gap? Here's the 4-minute chart. Opening price now doesn't look the same because we're looking at a 4-minute chart. So it was anchored on a 5-minute chart. It rallies up and break lower. Fair value gap right there, trades up into it, hammers it beautifully, and a displacement trades lower down into that 109. What was it? 1.0901 something or other. Can't remember off the top of my head, but it hit it. And I think the low of the day was 1.0901. So not bad. I mean, it's pretty close to perfect, right? But by itself, you don't want to try to aim for just that level because that's the best exit strategy. You don't want to do that. You want to fluff up your exits with a couple pips. I like to teach my students 3 to 5 pips. And if you're thinking a target is going to be, like, for instance, we'll say 1.0900 level. Okay, if that's what you think it's going to trade to, put your limit order to cover your shorts if you're short at 1.0905. Okay, you're not going to get the best exit that way, but you have a spread that you have to incorporate when you're working with Forex and FX pairs. Sometimes, and I've had a lot of this happen over the years as a FX trader, where my limit order was a little too overzealous. I was trying to be a little too perfect, and I've had many amazing exits elude me because of my overzealous targeting. So be a little bit more forgiving when you're trading, especially Forex. You got to incorporate the spread. And I know some of you have brokers where it's like, oh, I have a really tight spread. Let me tell you something. Every broker has the ability to open that spread up on you. You're seeing the best case scenario when that ticker is showing. But trust me, when it's advantageous for them, they'll work it in their behalf, not yours. So make it easier for yourself. Just fluff up your exits with 5 pips. Okay, and if you're really new, just use 10 pips. Okay, and if you're struggling with the idea that, oh, I don't want to do that, I'll give up 10 pips. Well, let me show you this. This would be your entry candle, trading right back to this old high here. So 1 pip add or thereabouts. Once it hits that candle with this run here, that right there would be your entry candle. Your stop would be right above this candle's high. Now, if you're scared or whatever, you can use this swing high and that's fine. Now, in terms of math, the entry price would be 1.09653 and your stop would be 1.09728 hypothetically. That's not a lot of pips. I would generally round that to 10. Even though it's not technically 10 pips here, I would round it to 10 and just be done with it. And looking at that model here, and you're aiming for that essentially the 1.09 big figure, fluffing it up a little bit so our exit price would be a little bit higher than that. You guys see these things all the time, and I just felt like using it just because I want to be cool. The risk is here, entry to stop, and the distribution to your target down here. Risk to reward ratio better than 8 to 1, and using a hypothetical $100,000 demo account if you're doing one of those funded account challenges or whatever. In this trade here, this gives you basically what you're looking for in one trade. So I don't know if this scratches the itch for you, but the stuff works in Forex. It works in index trading. So it's a matter of adjusting to what it is you're trying to trade. And then there's a little bit of rule following that you have to know when it comes to index trading and FX. FX, predominantly, you're working with 7 o'clock in the morning to 10 o'clock in the morning. That's your New York open kill zone. Okay. Index trading, I'm focusing on 8:30 to 11. And I can take a trade all the way up to 10:40, 10:45 and still be okay. I'm not interested in taking new trades generally after 10 o'clock in the morning in the FX pair, unless there is a news driver like we had this morning with the ISM number, the PMI number I mentioned earlier in the video. So that was allowing me to be a little bit more forgiving with expectations for price. you may not want to trade high impact news drivers. And that's understandable if you don't know what you're doing, but don't be afraid of them. Now, with the economic counter having that high impact news driver at 10 o'clock, that extends the New York session kill zone into the 11:30 time window because the volatility that it will bring in. Now, I didn't take this trade. I haven't taken any FX pair trades at all. Not for 2022 at least. But if you're looking at a model that works in index futures, you're looking at that 8:30 to 11 o'clock window. And if you're trying to apply this model to FX, it's 7 o'clock in the morning to 10 o'clock in the morning. Now, the high impact news drivers that come out after 10 o'clock, like for instance, if you're a Canadian dollar trader and the crude oil inventory number comes out, usually like 10:30 in the morning, you have to make allowances for that and just expect there to be a likely move on that oil number at 10:30. So just something to throw out there. I know a lot of you have been barking, wanting to see something FX related. As you know, predominantly I've been doing that since 2010, but I humbly submit this for your inquiry, and that way you can study this and listen to it a few times. It has a couple things in there that you may have went over your head. It's not terribly, demanding in terms of note taking, but there's some things in here that are noteworthy for you to have in your study journal. And for the most part, it looks like it works pretty good in this pair too, or in this asset class. So until I talk to you again on Thursday, be safe.
Be safe. All right, that was the 2022 mentorship slide 17. Hopefully everybody kind of understands the trade setup. What I look for, where I'm taking it to, hopefully that cleans it up. Maybe me and ICT don't say it in the exact same way, but that's pretty much it. I'm either expecting price to buy or sell in much in the same manner that he talks about time and price as far as New York kill zone. Candles have time too. The weekly range is going to take place, the way it takes place. Most people have seen the Market Maker series, or they've seen some semblance of it. Like I was talking to Newhoff the other day, and he's heavily biased for the higher the low be set Monday or Tuesday. So is ICT, and then the market reverses and goes the other direction. I mean, all of that stuff is the same. It's the reason that he said that the opening price is key. He wants to see price go opposite, trade above open if he's bearish. He wants to see price trade below the open if he's bullish. He wants to see a fake move first, and then he wants to see the real move. The same way on a weekly chart, if I'm bullish for that week, I want to see it sell first before it goes bullish. It's just the power of three, and you apply it to the scenario that you're looking for. You can use the power of three on a 1 minute chart. You can use it on a 5 minute chart, a 1 day chart, a 1 week chart, a 1 month chart, a 2 month chart. It's all the same. If you're bearish on a monthly chart, you want that month to start going bullish. And then you want to find your entry from the top to sell it back down. Is everybody tracking? So when y'all hear me say time and price, that is what I'm talking about, right? I'm talking about the time for the candle to move and the price. We're either at an advantage or we aren't, right? And you can start looking at those candles, right? The same way if the 4-hour chart gives you a bearish order block, we drop down to the 15-minute to look for price to trade back into that bearish order block before we take a sell. It's the same on every on every time frame. You know, we had that 2-month chart at the end of December for the JPYs, and we took a buy on the JPYs, and they bought for 2 whole months. It's not by accident. It's just how it works. Now we can't control how long it buys, but we do understand where we expect the trade to buy to, right? Based on the setup. You know, that's all we're doing. Is none of us run the market, but we look at the charts, and the chart prints, you know, whatever pattern or whatever order block or whatever levels that they print, and then we take our cues from that and we enter a trade based on what the chart has printed. Do I have any questions? Now is the time. You know, if you, what's that?
I say no question.
All righty. Does everybody know what they're trading this coming week?
I really want to get into Euro, USD, and some foreign currencies, like more currencies. I was advised, Kim was like, since you're so early, you know, I would tell you to work more on currency pairs, but I'm not really familiar with them. I'm still learning how to read charts and do the price action charting.
Well, let's talk about let's talk about reading charts. Terry, you said the JPY. We'll get on the JPY too, but let's look at a Euro USD chart, because you know, this hasn't been my favorite pair here lately. Euro USD has sucked pretty much. This is what I don't like to see, me personally. When the pair is range bound, and I get it, this is a 2-month chart, so it's a huge range. But if you look at the monthly, it's still just going back and forth. I prefer taking a trade from one level to the next. It's a lot easier for me to trade. I can set it and forget it. If it's consolidating, I'm running. I don't want no parts of it. So basically, since January of 2023, this pair has been range bound. And if you're a range bound trader, you know, you've had pretty much 600 pips to trade back and forth, right? So if you were to put your zones on here that old Kimmy Koo teaches, y'all put y'all little zones, your little key levels, you probably could have made a killing, and you would have noticed that the price is only going back and forth. So for me, Euro USD hasn't been an option. I haven't traded this pair. I don't know. I don't remember the last time I took a trade. But for me, I'd rather take a pair from a point A to a point B and not worry about it. Now, I expect Euro USD to drop. For those of you who, well, we just talked about this. The pair came from here to here, pulled back, broke that high, higher low, higher high. Now we broke this low, this internal low, just like we kind of discussed on that video. So we want to see price trade back into the imbalance, right? And it does. Then you want to see price break down. So I would expect that we're going to see this leg of price break down eventually to take out this low, right? And when it does that, it will trade back up to give you another entry to sell down. So let's see. On this monthly chart. On this monthly chart, I have a bearish order block. Y'all see that? On this bearish order block, if I drop down to the 4 hour, as a matter of fact, I'm just going to go back to the monthly and I'm going to fib it so we can see where we need to be looking. All right, so I marked my golden zone here. I'm going to change the color because I already got another blue mark. I'm going to delete the fib. So this is the zone that we need to hit for that bearish order block. If I look in this zone, I can already see imbalance in this candle right here, which makes perfect sense to me. I drew this line out a while back because this is relative equal highs. Generally speaking, in Forex, these levels don't last long. I would have expected for price to trade back up, take out these double tops and push down. Now that I see the zone, now I expect it probably to come up here and take out all of these highs before selling off. That's just what I would like to see. We will see if it actually does that. If you look at this setup, there was a way that if you were trading like the same way that I trade, maybe you would have traded this imbalance, you'd have caught a sell from this imbalance. But in my opinion, because we haven't traded up into the zone of that monthly order block, I think price is going to come higher to go to discount before it actually, to go to premium before it actually sells off to break that low. I'm going to hit the 2 month. 2 month is a bullish order block, which means the price could go bullish. I don't necessarily believe that either, but I'm just going to mark this 2 month candle up just so I can see where the retracement is on it. It's probably going to be similar. Okay, if this is a bullish order block, if we're expecting price to just retrace on this red candle, the 62 is about at the start of the 50. So I think there's no way that price is not going up here, right? I think that price is at least coming to our zone. And I would expect a reaction in our zone, or it could come higher. The 78 is right here for the bearish move, and the 78 is right here for the bullish move. So I think either way, price is going there. Now, I can already hear some people questioning or probably like, man, that's a bullish order block. So price should go higher. It is a possibility that price could go higher, maybe to this imbalance. But I'm just thinking fundamentally that that price is not going to go higher. I would need to see price break the zone. So I'm not trading this, again, if I was trading this, I would still only be trading this up to this imbalance. So if I'm taking a trade, which I'm not, but if I was taking a trade, I would be looking for these 105 pips. This is the move that I would be looking for. And, maybe we get that. If it keeps pushing higher, I would target these equal highs. If it keeps pushing up. So I'm bullish until this area. Then I have to see. This is a classic example of why I'm not trading pairs that aren't going anywhere. It's just going back and forth. So if you told me this was buying, I'd say you was right. And if you told me it was selling, I'd say, yeah, you're right. Because it's doing nothing. It's been doing nothing all year, but going back and forth. And it's a high likelihood that it just go back to the same zone and bounce. So I don't know. Hopefully that cleared up. Hopefully that's as clear as mud for you.
Well, what's the macro? I mean, what are they doing with interest rates in the dollar? What are they doing with interest rates on the euro?
We don't know. And that's the thing. So we're not lowering and they haven't lowered. So it can probably just bounce back and forth until there's some clarity. Somebody has London is in a recession. They came out and said it. So the pound is probably going to end up selling. But the euro, they haven't said that they're officially in a recession. We haven't said that either.
Where's Elfie at? Some of these other people that live over there, what are they saying? Anyway, that's I think you're right. I think eventually it is going to sell. But I think until they do something with the interest rates, or we do something, that I think that's why you're getting this consolidation until they're probably going to lower if they're in a recession or perceive they're in a recession. They're probably going to lower their rates, and when they do, this thing is going to probably sell off. But until that happens, you probably get the sideways action.
I'm biased for the overall sale, but I think we got to go over here first.
Well, you probably do. The other thing I was going to ask you to do is put a fib on that down move, and larger down move, and have we retraced to 62? I guess would be my question. Well, the bigger move.
All right, we'll get to that. That's the 78 on the smaller one.
Okay. But you see that bigger move?
The war move. This is the war drop. And we did retrace to the 61 or 62.
Right. So I don't know. I mean, I guess there's probably a possibility you can go higher to the 78. I don't know though.
Well, I would base it off this last chart.
Yeah.
This tells me we're going lower, but we have to trade up higher before we go lower. That's what I would say.
Yeah, I mean, I agree. I mean, I think the only way the only way this goes higher is if the US lowers our rates before they do in Europe. If Europe lowers theirs first, I don't think you can get to the 78.
Me either. But I think this kind of feeds into what I believe anyway. I believe that this week is going to be bad for the dollar. I believe we're going to get this move up. Then I believe we'll turn and burn.
Yeah, it's probably something I think there are probably easier trades out there than trying to guess what somebody's going to do with their interest rates. I probably wouldn't trade this either.
Yeah, I mean, I've said that over repeatedly. Um, Terry wants to see the GJ sell.
I was just joking, Todd. I already got my setup. I know what I'm doing.
You know, but I think we beat this to death last night.
Say it again.
Hmm?
What you said?
I think we beat this to death last night.
Exactly. I was just joking around. I know what I'm doing.
You in a buy?
I got into that fail. Now it might buy up a little bit, but I'm expecting to sell.
I'm expecting to sell too. I know y'all don't like to hear what I gotta say about it. Well, we're gonna talk about it anyway. Timmy, that thing is going to hit, boy. Tim,
Yes.
I know you told me it was buying, but I don't think so.
I said it was bullish. That's what
I
I said.
It is bull.
At the moment.
It sure is. It sure is bullish. I think it's telling that it wicked that line right there.
It tapped into price action. Typed into price action.
Imbalance. I think it's like Mary J now, bro. Mary says she going down. I'm looking for GJ to go down too.
Seriously.
Mm-hmm.
It's not going to sell, but what I'm saying is it's overall bullish at the moment. So all I'm saying.
It's bullish with bearish. So you buy it then. It's bullish with bearish vibes.
No, I'm not buying. Well, I am buying.
Buy
I'm
it.
in buy.
No, put you in a new position. 20 lots right here. Prove to me you trying to buy. Prove it. If we just trade back to this imbalance, that's 270 right there. 270. I like this sell setup though. I'm not gonna lie.
Got to break the key level for me before I get in the sale.
Yeah, it's gonna break keys and levels.
It's got to break levels
I like
before I get in the sale.
I think this has got a daily bullish order block. I mean, it got a daily bearish. Yeah, this is gonna sell. Sweetheart, this is gonna sell. This is the LP pair right here.
Ooh, I was just gonna say,
LP, close your eyes.
Sequa. I see you like her now. Don't
Hey,
even like
the hit count is high. I like it.
right.
That's 181 today, imbalance.
Well, GJ juicier though.
I don't know if it's juicy or not because I really think these are gonna sell. Like I think they coming way down, like to these levels. So
At least to that first imbalance. How much is that?
it's
Where you got your green line right there?
181 pips. I like UJ.
UG look real good.
I like UJ because it already did its business. It went up there and checked in and everything. And if we have an NFP week, if the NFP report is like I think it's gonna be, UJ gonna be way down here somewhere. Price pushed down. We broke all this structure in here, came back up, did not give us a higher high, gave us a lower high. This push, I expect to get low, get low, get low. Anywho, whatever you believe,
I don't
man.
know how my instructor don't see that, Todd. How my instructor don't see that?
Yeah, Ray Charles see it, man. Your instruction she just blind, man. All I'm saying is it's gonna be some great opportunities. It's gonna be some great opportunities to get low. Mm. Some of these trade setups aren't what you're looking for. So if you don't see your grade A setup, all I can tell you is don't be a trader, man. If you don't see this as a breaker structure and a trade back up into an imbalance to sell, don't trade it. Don't do it. Maybe you see this as an inverted head and shoulders and prices going higher. For me, I can fib this green candle. I can look for a pullback to at least the zone, but maybe that's not enough pips for me. So I could make an educated guess and say, man, price is going to come back and deal with this imbalance at least, right? If it comes down further than that, then you got all these wicks, these uncollected orders. You know, I don't know. Maybe this might be Kim's key level. I don't know. You know, if she was on the call, she would say it's a key level because I'm doing it. She's probably gonna say it's not. You know, but this might be like one of them super key levels for y'all to trade. If that's the case, from where price is right now, you got about 130, 140 to close this imbalance and tap into that order block. And if it goes down to this level by 188, I mean, it's still a great trade in my opinion. No matter your long-term outlook. So if you understand what you're looking for, in my opinion, then you have a trade setup. Anybody have any questions? Asking autumn questions. Asking autumn questions. Everybody's good.
Everybody good?
All right.
Good night, Ish.
Good night, Ish. That was quick and painless.